welcome to week 3 of this 12-week journey that we're taking together. We're now getting into the actual trading and how we're going to use everything that we've talked about philosophically over the past 2 weeks and put it into the market itself and trade it. This week, our goals are to do several things. Number one, we want to meet Mr. or Professor Al E. Gator. We want to learn about what is the trader's most important problem, and it's not making profits, it's keeping profits or not losing money after you've made it. Trading for profits is fairly simple and fairly easy. Keeping the money you make is not that easy. We're going to look into how this alligator is a system that we use to asset allocation or do our asset allocation to tell us which trades to take, which way to go in the market, whether we're buying or selling, when to buy and sell, how the market is made up and how the alligator is made up, how to trade it, and then we're going to give some examples of how it works in the actual market. So we've got a big week planned out here, and right now what we want to do is to go over here and meet Professor Al E. Gator. Here's Professor Al E. Gator, and Al E. Gator is going to teach us how to profitably trade both stocks, bonds, and commodities on any time frame, on any chart. The first job that Professor has is to teach us about how the alligator works, when he's hungry and when he's not hungry. The purpose of the alligator is to allow us to enjoy the gain that we get from trading and to avoid the pain of giving the money back. So the first thing we want to do is look at traders' biggest problems. And trading's biggest problems, believe it or not, is not making profits. That's not the problem. The problem is keeping profits by not having whiplashes. That is all traders' biggest problem. Another problem is that most traders say that making money is easy, but keeping it is hard. There is a solution to this, and we call that solution the alligator. So today our goal is to learn about the alligator and how it works. Here's a typical trading market. Most of the lifetime of any trading market is back and forth and back and forth. We call this a range-bound or a bracketed market. As a matter of fact, if you take the lifetime of a market as 100%, then 70 to 85% of that market, whether you're talking about bonds, stocks, or commodities, or even options, 70 to 85% of the time, that market just goes back and forth in a rather narrow channel. Only about 15 to 30% of the time does the market trend. And we call those blind chicken trending markets. My grandfather used to say that even a blind chicken every now and then will discover an ear of corn. So if you buy here and get out there, we call that a blind chicken trade. We don't want to miss those, but the most valuable part of this whole chart is right down at this point here, at this last trend change. And that's the point we're looking for. And those blind chicken or trending trades only happen about 15 to 30% of the time. So this is a typical trading market. What we want to do in this market is to stay out of the market during this range-bound bracketed period and be in the market heavy when that trend starts to move. And the key to doing that is the alligator. Then the question comes up, what is the alligator? Well, 3 things. The alligator is an integrated approach to monitoring the market's momentum. And remember that it's momentum that moves the market, not the price. Second thing is it's a simple indicator to trade only with the current trend. If we're trading against the trend, we call that feeding the alligator. We don't want to do that. And it's a protection device not to lose money during bracketed markets. Let's go further. The basic alligator strategy is simply to wait for a trend to prove itself by breaking out of the old barriers, that bracketed market, and using the fractal, which we're going to learn about next week in week 4, as our very first entry. The second strategy is to stay out of the market when the price is inside the alligator's mouth. In other words, when the alligator is asleep. And the third strategy is a basic stop would be when the price re-enters the alligator's mouth. So here it is, very short and simple. An alligator likes to sleep. In fact, it spends most of its life sleeping, just like the market. And the longer the alligator sleeps, the hungrier it gets. And when the alligator starts to awaken, what it usually does is stick one nostril up above the water, if it's in the water, and smells for some meat, either some bear meat or some bull meat. Same thing with the market. When the market is sleeping, when it's in these bracketed markets, when it starts to awaken, it then decides which way it's going to go up, whether it's going to go up or whether it's going to go down. If it's going up, obviously we want to buy. If it's going down, we want to sell. So today, in addition to your reading about the alligator, our big goal today is to understand how the alligator's behavior mimics the market's behavior. Or it may be the other way around. Maybe the market mimics the alligator's behavior. So the simple rules are simply this. We want to go with the trend. We don't want to miss the trend. And the fractal, which we'll study next week, will absolutely guarantee that you're not left out of any trend. When the market's not trending, we want to go someplace else. As we said before, repeating it, if you're looking at a bunch of commodities or stocks or bonds, only a few of them are going to be moving. So most of them are going to be asleep. So if you see a whole herd of alligators, most of them are asleep, then one or two will awaken, and they start looking for food. When the alligator's looking for food, that creates a trend market. We want to be very aggressive in trend markets, and we want to trade, and be two things. We want to be a very aggressive trader and a very conservative physical money manager. And we can do that using the alligator. The alligator also takes care of all of our asset allocations, and it does one other thing. It allows you to trade with the Elliott wave without knowing what Elliott wave you're in. Anytime the price bars are outside the alligator's mouth, you're in a trend. Any impulsive wave. Anytime the price bars are inside the alligator's mouth, you're in a reaction wave, you're in a bracketed market. So we're doing several things with the alligator. We're taking our asset allocation problems to him. He's going to solve those. He's going to tell us when to get in the market, how to get aggressive, when to get aggressive. He's also going to tell us when to take profits. So the alligator is going to be our very best friend in the market. This is our structure. This is our underlying structure of the market. And it's based on momentum, not on price. And the market runs on momentum. For example, if you have a bowling ball in your hand and you roll that bowling ball down the street, it's the momentum that keeps that bowling ball going. If it hits an incline, it's going to slow up until gravity takes over. Then it's going to turn around and go back the other way. In the market, we call that a change in trend. But the instant that this bowling ball starts to slow up, from a physics standpoint, it's really accelerating in the opposite direction. It's as if you were in a car and approaching a traffic light. Your momentum is still forward, but as you start to put your foot on the brake, from a physics standpoint, you're really accelerating in the opposite direction. So this week we're going to show you how, by using the alligator's momentum, we're going to be able to, in effect, read tomorrow's Wall Street Journal or today after tomorrow's Wall Street Journal today. Can you imagine what an advantage that's going to be? So I hope you're a little bit excited now that we're getting into the market and getting to the underlying structure of the market with the alligator. Remember to do your morning pages and your AT, and tomorrow we're going to learn more about the anatomy. We're going to take a course in Alligator Anatomy 101. We'll see you then. Welcome to day 2 of week 3. We're now getting really excited about the market because today we're going to experience a number of things. Our goals for the day is to understand the construction of the alligator, to understand how the alligator allocates our trades, and how the experience of the alligator behavior works in actual markets. We're going to look at some actual charts for the first time, understanding how the alligator works. So let's go and look at the alligator. What we're going to look at now is the Alligator Anatomy 101, and we're going to look at the alligator setups. We're going to look at 3 different balance lines. Now, a balance line is where the market would be, where the price would be, if there were no new incoming information. So the distance between this balance line and where the price actually is a result of new incoming information. And we're going to set these up so that it will be more alive to us, more realistic. And we're going to call the blue line the jaw line. The setup of the jaw line is this is the balance line on the current time frame displayed on the chart. So if we're looking at a daily chart, it's a balance line on the daily chart. If we're looking at a 5-minute, it's a 5 minutes. The construction of this, and this came from a Cray mainframe mathematically, and then we inputted it into a formula that could be used on any PC. Here's what it is. It's a 13-bar smooth moving average that's offset 8 bars into the future. Now, we'll show you this on a chart in a few minutes. But the important thing is that this is the jaw of the alligator. This is the balance line for the current time period. Now, we're also going to put in the teeth. And the teeth of the alligator, we're going to color the teeth red. This is the balance line for one significantly shorter time frame. Now, it is not a clock time, but it's roughly a factor of 5. So if the blue balance line is on a daily chart, then the red balance line would roughly be on an hourly chart. Not exactly because of clock time. This is figured out by the computer. But it's constructed in the computer and can be done on most any computer by using an 8-bar smooth moving average that's offset 5 bars into the future. And then the last line we want is the lip line, and we're going to paint that line green. This is the balance line for still one more significantly shorter time frame. It's a 5-bar smooth moving average offset 3 bars into the future. Now, this may sound complicated at the moment, but it really isn't. We're going to show it to you on a chart by itself, and then we'll show it to you on some charts with the price lines on. But just to review, we have 3 lines. Those 3 lines are all 3 balance lines, and we're seeing all of them on one chart, but these are the balance line for 3 different time frames. The jaw is the balance line for the current time frame that's on the chart, and we color it blue. The red is the teeth, and it's the balance line for one significantly shorter time frame, and the green is the lips of the alligator, and that's still one more significantly shorter time frame. These are constructed by 3 different smoothed averages that are offset. The jaw is a 13-bar smoothed average offset 8. The teeth is an 8-bar smooth average offset 5, and the lips are a 5-bar smooth offset average offset 3 bars into the future. So now let's look at the alligator on an actual chart. Here is the alligator's mouth on a chart. This is a coffee chart. It's a daily chart. Basically, it's about 2.5 months of coffee. And what we see here is the blue line, and remember that the blue line is the jaw, and this is a 13-bar offset 8, and the red line is the teeth. That's an 8-bar smooth average offset 5, and the green line is the lips. That's a 5-bar offset 3. And this is the alligator's mouth. Now, when you see the alligator down here, the alligator's lines are intertwined. The alligator's sleeping. The alligator wakes up, and he's opened his mouth, and he's searching for some bull meat. Now let's look at this same chart, and by the way, we're going to use this chart for several different slides here to illustrate how it is, but we're going to put the prices on this exact same chart. This is how the alligator looks on the price chart. We're still looking at the same time period. We're still looking at coffee with the price charts on. And notice that in this time frame over on the left, the alligator is sleeping. About midway here, the alligator wakes up, and the alligator is searching for this food. One way that one of our traders looks at this, he looks at this as if the price bars here were little fish, and the alligator is chasing the fish, and the fish are trying to get out of the alligator's mouth. Once again, we have the sleeping alligator here. The sleeping alligator is indicated anytime the lines are close together or they're intertwined. And then the hungry alligator, who's searching for food, is here. Remember our slide on the bracketed market. The bracketed market is this market here, and the blind chicken trades are in here. So anytime the price is above the alligator's mouth, you want to be very aggressive in going long, but you want to be very cautious in going short, because if you went short up here, in effect, you're feeding the alligator, and you're feeding the alligator your money. So you don't want to do that. So this is the way that it looks on a chart, on a price chart itself. Let's look at a couple of more charts. Here's a Coca-Cola stock chart, and this is about 3 months of a chart, but you can see that in this period here, the market was going nowhere. This is the sleeping alligator. Then the alligator woke up, and in this chart, the alligator wants some bear meat, and during this time, and we'll explain this next week, but this is your first fractal out of the alligator's mouth that's hit, so you would be short in this area here. All during this time, you would be short, adding on, aggressively adding on, and not getting out until the price went back into the alligator's mouth. So then you took all of this profit way up here from 70 to 60, and that is roughly about almost a 20% profit in a period of less than a month, which is pretty exceptional for a stock trade, and going short on the Coca-Cola. Let's look at another one. Here is Microsoft, and here we see several instances. Here is the sleeping alligator. The alligator wakes up and he wants some bull meat. So during this time period here, the only thing you would do is take longs. You would not short this market at all. You would not sell into this because you would be feeding the alligator. You would not sell into here because the alligator's mouth is closed, which is indication the alligator is sleeping. You would go long here, and you would be long, and you would be long through this movement. You would be out here because the alligator is sleeping, and at the current time when this chart is over, you would be long. And I hope that you can see the advantage of this, and it keeps you always on the right side of the market. Let's recap what we've done today. What we've looked at today is the alligator's anatomy. Anatomy 101, we looked at how the alligator is constructed. We know that the balance line, and we have 3 balance lines which create the alligator's mouth. Each balance line is where the price would be if there were no new incoming information. The blue line is the balance line for the current time frame that's on the chart you're looking at. The red line, which is the teeth, is one time frame, a significant time frame lower, and the green line is one more significantly time frame lower. That creates the alligator's lips, teeth, and jaw. And this is our asset allocator, and it tells us which way to go and what kind of buys or sells to take. So if the alligator's hunting bull meat, we wouldn't feed the alligator by going short, and if it's hunting bear meat, we wouldn't feed the alligator by going long. Our basic strategy is to do nothing until we have a confirmed breakout outside the sleeping alligator's mouth. Now, one of the characteristics of an alligator is, as we said before, is that when it's sleeping, the longer it sleeps, the hungrier it gets. Same thing is true in the market. The longer that a market's in a bracketed frame of mind, the bigger the move is going to be coming out of that market. So at the very time that the market is the most boring to look at is the very time that we should be the sharpest, because here the alligator's sleeping and we want to see him take his first yawn and his first breath awakening to his hunger, and we want to follow him and let the market tell us exactly what to do. That way we don't ever have to worry about things like having to outsmart all the other traders or to predict the market. We just watch the alligator and ride the alligator's back. So remember to do your 2 ATs and your morning pages, and that about wraps it up for week 3, day 2. Welcome to week 3, day 3. We're approaching the middle of this 3rd week now, and we've looked at the alligator, and I hope you're getting a little bit excited about how the alligator can really make you a fortune if you do it right and just do what it says. What we're going to do today is look at how the alligator behaves in various different markets, both stocks and commodities, and we're going to see how simple it is and how that we don't need any other information. In fact, when you come here to a private personal tutorial, one of the things we're going to strongly suggest to you is that you do not look at FNN, you do not read the Wall Street Journal, you don't read any newsletters. All you do is communicate with the market itself and let the market tell you exactly what to do. So today's goal, we're going to get more experience in using the alligator as an aggressive asset allocator and an entry into the market. So let's go right to the charts themselves. Here we see this same chart of the coffee that we saw yesterday, except you'll notice there's a few other little things that are on the chart. And what you see are these little green deltas here. Those are fractals. And next week we'll talk about fractals. In fact, we're going to spend the entire week on fractals. But remember that our strategy is that when the alligator is sleeping in this direction over here, we don't want to get into the market until after we see the first fractal outside the alligator's mouth. This is the first fractal outside the alligator's mouth. This is a fractal going short. This is a fractal going long, which was hit 3 days later. So the first thing we want to look for is our first fractal buy outside the mouth. Now, granted that we haven't talked about the fractals yet, we just want to show you today, this is kind of the bamboo steamer and Ginsu knives. This is kind of a temptation for you to get excited on this. Here's our first fractal outside the mouth. Here's our second fractal, our third fractal, fourth, fifth, and sixth fractal. So on this chart, we would take every one of these. Our first buy would be a buy when that is triggered. This would be a buy. It wasn't triggered until 2 weeks later. Then this was triggered about a week later. This was triggered 3 days later. This was a week and a half later. And this was about a week later. But in this move, in this 2 months move, we had 6 entries, 6 fractal entries to go long. No way could we go short, because if we went short, we would be feeding the alligator. Now, we do have some fractal indicators here and here and here, for example. But again, since we're outside the alligator's mouth, we want to let the alligator chase the price. And we want to be on the side the alligator's moving. And this is the first example that we'll look at. Now, here is a fractal down here at B, this point here. But notice the price never triggered that fractal. Here's another fractal down here at point A, and this was a fractal that was indeed triggered on this date. So while the alligator's mouth is closed, you may have a few whiplashes. But even with 2, 3, 4, even 5 whiplashes, you're going to make so much in this move, this blind chicken move up here, that you won't be worried about those small incidental losses. Let's take another example. Let's look at Dell Computer. Now, this is Dell Computer for 3 months. And notice that your first fractal outside the mouth was here. You had a fractal down here, you had a fractal down here, but neither of those, the price didn't go past it, so they were never triggered. Here's your first fractal outside the alligator's mouth. It was triggered about a week later. You did not go short anywhere because you would be feeding the alligator, and we'll talk about how to get out later, but you would not be out of this. Now, here was a fractal up. This fractal was not taken because a fractal was hit later at a lower price. And remember that we're trading the market of what's happening now. So here's your second fractal, third fractal. Your fourth fractal didn't hit until there. Your fifth, your sixth, your seventh, and your eighth has not been hit. But you were in this long all the way through. You would probably have not gotten out until this point right here. This close below the teeth, or inside the teeth, between the teeth and the jaw. This is coming later. Don't worry about that right now. Our job at the moment is simply to experience and to see how the alligator, using the alligator, keeps you in tune with the market so that you're always trading with the trend and not against the trend. Let's look at some other examples. Well, let's look at this first fractal buy just to review. Here's 2, 3, 4, 5, 6, and 7. Let's look at another chart now. Trading the balance line outside of the market. We're going back to the coffee chart now for 2 months of the coffee in April and May. And what we're going to do here is show you the buys on the balance line. It'll still be several weeks before we look at this way of entering the market. Again, what we want to do now is just give you a sort of a preview of how all of this adds up. And we're going to use this same coffee chart, the same 2 months, and see what would have happened if we had traded this in an almost mechanical fashion, taking every trade in the right direction as discerned by Professor Al E. Gator. So the BF here, that stands for the beginning fractal. That's the first trade we would take. This is the first balance line. Now, don't get upset because you don't know what a balance line trade is. That's okay. We're going to cover that. Here's the second balance line, third balance line, fourth, fifth balance line, sixth balance line, seventh is up here, and we have an eighth. So in any trend move, you're going to have more balance line signals than you have any other signals. So in this same 2 months, we had 8 buys that were triggered by the balance line in addition to the fractal buys that were triggered by the fractal. Let's look at another example. Let's look at the AO signal. Now, the AO signal is based upon the momentum. And the momentum we illustrate in a chart down here, a histogram chart at the bottom. This is the momentum of the market. And the momentum will always move before the market moves. As a matter of fact, the price is the last thing that moves in the market. Before the price moves, the first thing that moves is the momentum will either accelerate or decelerate. Then the next thing is the momentum will change direction. Then the next thing is the volume. And then previous to that are all the traders like you and I making all these crazy decisions. So the price is the last thing to change, and we want to anticipate the anticipators by getting in before the price itself really signals a change. Now notice that the momentum changed at this point here, but the price really didn't break out for several days later. Let's look at that on a closer examination. Here's our beginning fractal. Our first AO signal was when it crossed the line. Now, crossing the line here, the first fractal has not been taken, so that we would not take that signal. Now, I know that I'm speaking Greek now because you don't understand what a AO buy signal is. Just bear with me for a few minutes. This one we would take, and then we have 3 saucer buys that we would add on. So we would have all of these buys in addition to the balance line and in addition to the fractal. Let's look at the accelerator now. The AC is the accelerator. That's the one that tells you how fast the momentum is changing. Once again, we don't do anything until we have that beginning fractal outside of the mouth. And then we look for the momentum buy, or the acceleration buys. This price bar here, this buy signal, was not taken because it was not out, it's a buy signal, and it was not outside the mouth. It was on the wrong side of the mouth because it was underneath the jaw instead of being above it. So had we taken that, we would have been feeding the alligator. So we wait for that first beginning fractal. Here's our first buy. Here's our second buy. Here's our third buy. And here's our fourth buy. So we have fewer of these signals than we have the balance line or the AO, but we have 4 more signals to add to this 2-month campaign. Now look at what happens when we combine all of these signals. When you combine all of these signals in 2 months, and before we show you, just imagine what you could make if you had traded all of these on a daily basis. Now this means that you could do whatever you want to during the day, and you could analyze this chart in less than 10 seconds. And if you have any problem analyzing the chart, we have some proprietary software that's available that will analyze the chart for you in 1 keystroke. But had you traded this in just 2 months of April and May of 1997 and taken 1 contract per signal, now again, this is no intraday trading. This is not watching the market during the day. This is putting in your trades either after the market closes or before the market opens the next day. But had you taken every one of these signals exactly following the rules, you would have had over $500,000 profit in 2 months by starting with an account of not more than $50,000 to $60,000. With that kind of returns, we hope that this gets you a little bit excited. We hope that this is at least a slight turn on for you. And now let's recap what we've talked about today. Actually, let's recap the week so far. We started off the week by talking about we want to take blind chicken trades. We don't want to trade while the market's bracketed. Yesterday, we looked inside the structure of the Alligator Anatomy 101. And what we did today was look at several charts, but primarily the coffee chart, and showing you how if you used all 5 grounded dimensions, and remember that the grounded dimensions are the door openers for the underlying structure of the market, then we can anticipate what the market's going to do. And very simply, the way we use the alligator is that when the alligator is sleeping, don't trade. Just sit there. But watch the market, because when it wakes up, when it first starts to wake up, we want to get in the market, and while it's hunting its food, we want to be just ahead of the game and be very aggressively trading. So when the alligator's mouth is open, the alligator is going to direct us which way to go. And the alligator is going to be our asset allocator, and it's going to be our odds maker, so that the odds are on our side and we're trading with the underlying structure of the market, and winning becomes the path of least resistance. Tomorrow we're going to look at the S&P. We're going to examine 3 months and 2 weeks of trading the S&P and see how you would have fared in the S&P trading the same techniques exactly on a different commodity that's moving well. So do your morning pages, your twice-a-day AT tapes. We'll see you here again tomorrow for day 4. Here we are at day 4, week 3, and our goal today is to look at another commodity, the S&P, on a daily basis, and hopefully to impress you with how powerful this approach is once you get in touch with the underlying structure. And remember from last week when we were talking theoretically about the underlying structure, where winning becomes a path of least resistance, we're letting the market itself, the new incoming information, organize itself. And remember that the alligator tells us where the market would be, where the price would be, if there were no new incoming information. And the alligator also is our odds maker, it's our asset allocator, and it tells us when to buy, how much to buy, and when to sell. So let's go now back to the charts, back to the real charts, and let's look at the S&P over a 3-month, 1-week period. This is a chart of the S&P 500, a daily chart, and this particular chart happened to be before they cut the value of the ticks in half. This time, when this chart was active, the points were $5 a point. And here you can see the alligator was sleeping, the alligator was awake here, and it was awake here. And basically our best stop strategy is a close below this red line. So you see that during all of this period, from May through July, May, June, and July, the alligator, the close was never below the alligator's teeth. The numbers that are going to come up indicate the fractal signals that are hit. Here's our first fractal, our second one, our third one, fourth one, fifth one, sixth one, seventh, eighth, ninth, and here's our 10th. What we want to do on each of these is to analyze this and get an idea. Now remember, we're talking about 3 months and 1 week from the first fractal buy until the end of July, when this chart, the end of this particular chart. So we're going to break each one of these down and look at them. This is the S&P fractal results. Had you traded nothing but the fractals during this period of time, your first buy would have been on April the 17th, your first signal, excuse me, your first fill would be 5 days later on April the 22nd. And then the next one was the 24th and so forth. You had 9 trades during this time, but look at the bottom line. Had you traded each one of these, you would have had a profit of $368,000, a little bit more than that. Also, look at the slippage. For example, on this second trade, we had a gap opening. We had a gap opening of 3 big points. That's a $1,500 slippage, but the profit and loss from that trade was still almost $81,000. This is trading only the fractals. Now, when we add the other 4 dimensions, it's going to be even more spectacular. Here is trading the balance line. And notice that here on this chart, we only put the alligator's jaw. It's the same as we saw on the chart before. None of these closes were below the red line, and we only put the blue balance line to make it a little bit simpler. But remember, we said yesterday that in a trend run, you're going to have more balance line signals than anything else. And we had 9 or 10 fractal signals. We've had double that amount of balance lines. So the probability is that there's going to be more profits made on the balance line. And let's look at the balance line. Here's a bigger view of it so you can see it a little bit better. But the balance line results, you had 19 trades actually, but look at the bottom line over here. The bottom line is you had over $700,000 in profit. Again, I want to remind you that this is no trading during the day. This is putting in your orders after the market's closed or before the market's open. And this includes the slippage. Here we see the same exact chart, same time period, and for simplicity, to keep it less complicated, we're leaving out the alligator's mouth and the alligator's signals. The alligator's teeth and lips. We would never do this when we're trading, but we did this here just to make it a little bit more simple to show you the number of AO signals. The AO signals are taken from the momentum, which is this histogram here. And we've colored this so that if these bars are green, that means it's higher than the previous bar. If the bars are red, it means it's lower than the previous bar. And that's when the momentum turns around, that creates our signals. So the AO signals, and the AO, by the way, stands for the awesome oscillator. These are the AO signals that are taken. Notice these little squares here are the AO signals. But this AO signal was not hit. This one, there's some of them that were not hit. Here's a AO cell. And of course the AO cell was not taken because that would be feeding the alligator. So it's in a blind chicken trade. We're going up and we only want to take buys. Let's look at the results. Here's the result of taking the awesome oscillator signals. And remember that there were 8 of those, and the total profit on that was $235,000, almost $236,000, just taking the AO signals. Now let's look at another one of the 5 dimensions. This is the AC signals, and down here on the histogram chart is a chart of the AC signals. Here are the signals that were hit. We had one here, the second one was hit there, the third one was hit there, the fourth one was hit there, and the fifth one was hit there. Now, each one of these is noted by these little dots, and notice that there are a number of dots where there's no numbers. These were signals that were generated but were not hit and were canceled by the market because of the AC. And again, don't worry about that. We'll talk about that later when we talk about the AC. And Justine will explain how we use the AC, how we create it, and how we trade it. Let's look at the results from just the AC. The AC alone had over almost $250,000, $226,000, $150. So we have the AC. Now let's look at the zone signals. The zone signals we're not even going to attempt to describe now. We've just numbered them. This is the same chart. We've kept the alligator off again for simplicity so you could see it a little easier. Let's go quickly then to the results of that. The zone results were almost $500,000, $452,000 and 100 in addition to that. So now let's look at all of these signals together. This is trading the S&P. Here the signals are all indicated on your chart, and you have this chart in your manual and also in your textbook. The deltas, those are fractal signals. The lines, such as this one right here, this one right here, this one over here, are all balanced line signals. The squares, such as this here and that one, are AO signals. The diamonds, which are these dots here, and the red ones, remember, we would not take those because those are sell signals. We'd be feeding the alligator. And the diagonal arrows are the zone trades. So putting all of those together in this 3-month period, you had 46 trades. And you also had 46 winners. Now, I would love to tell you that that's normal and that's average. That isn't. That's extraordinary. We normally don't have that many winners in a row. But can you imagine how much the profit might be? This was trading from May or through May, June, and July, and the total profit, had you taken each one of these signals, allowing for slippage, would be over $2 million. Now, if you're an experienced trader, you know that the S&P oftentimes has slippage. If you allowed over 2,000 points per entry for slippage, in other words, if you allowed over $10,000 per signal for slippage, which is an atrocious amount, which has never happened, you would still have over $1,850,000 in that trade. So it's important that we put this statement in broad print so you can see it very clearly. It is important to note that past performance does not guarantee future results, but let's examine that past performance a little bit more closely from a statistical point of view. Let's look at combining these 5 dimensions. And when you combine the 5 dimensions, which are the fractal, the balanced line, the AO, the AC, and the zone trades, you get in excess of $2 million, including slippage. And that's from April the 17th through July the 31st. Let's look at this another way. Let's do a daily trade analysis. Of the 9 fractal signals, that was the profit generated. Dividing that by 9, the average profit per trade was slightly over $40,000. The average balance line per trade was slightly over 37. The AO was the lowest. It was 29. The AC was 45, the highest, and the zone were 41. Now, the interesting thing to me as a trader and as a scientist and as a statistician is that the average winner was $38,000. Now, notice that the average was 38, but notice how close all of these are to 38. This is the furthest one out, and it is less than $9,000 away from the average. What that says is that the level of confidence, if you do a chi-square test or a statistical test on this, is very, very high. This could not be, in other words, due to chance by any stretch of the imagination. So to recap what we've done today, we've looked at the S&P using all of the 5 dimensions and the alligator to show you the possibilities and the potentialities of using this technique of trading the market. And hopefully we've also shown you how simple it can be. And all you need to do is follow the alligator, do what the alligator instructs, and then take every signal that the alligator allows you to take. This is going to be the end of day 4 of week 3. Tomorrow what we're going to do is we're going to recap the entire 3 weeks that we've talked about so far. And then next week we're getting into the fractal, and we'll get into more and more trading. We'll see you tomorrow. Make sure you remember your 2 ATs and your morning tapes. Well, wow, here we are at the end of week 3. What we want to do today is we want to review everything we've talked about, and I strongly suggest that you go back through the study pages, that you use your computorial and study everything that we've covered so far. The first week we looked at the market, finding out what the market really is. We know that the market is, the purpose of the market is to find that place where, in price, where there's an equal disagreement on value and an agreement on price. We know that if we understand that part of the market, we can eliminate a lot of things like oversold, overbought concept, bullish consensus, bearish consensus, many money management products. And we know that the way to win in the market is to simply believe and follow the Holy Grail. And the Holy Grail is simply the 5 words, want what the market wants. To want what the market wants, what we have to do then is we have to give up our own dispositions, our own preferences, and go with the market. To do that, we have to understand the market. And the best way to understand the market is using the new science of chaos, fractal geometry, nonlinear dynamics, which also includes information theory, cybernetics, and holography. All of those are big fancy words for saying one thing. Chaos simply means new information. And in any structure, in any chaos, there's always an underlying structure. And any energy, anything in the earth, anything in the universe, always follows the path of least resistance. So what we have to do is make winning in the market the path of least resistance for you and for me. To do that, we need to understand that the path of least resistance is determined by the always underlying and the usually unseen structure. And the third principle from the science of chaos is that this underlying unseen structure can be discovered, and very importantly, it can be changed. So that means that we also can change our own underlying structure. And that indicates we can change our belief systems, and as we said in week 2, when you change your belief systems, you change the way you trade and you change the way you live. Then in the second week, we spent almost the entire second week looking at the science of chaos, looking at how we organize new incoming information. The fact that we're taught from day 1 to organize it into past categories, which are also belief systems. We also know that nobody trades the market. We all trade our own individual belief systems. So if we want to change our results, it's much more efficient and much more profitable to change our belief systems than to change our way of trading the market or our system of trading the market. In that respect, remember that the day 2 of week 2 was the most important day of the entire course, and that was how do you handle new information. The way we're taught is to massage it, distort it so it fits into our old categories and our old belief systems so that we literally only see what we believe in. We don't see what we don't believe in. Now we can change that. We can change that by allowing the new incoming information to organize itself. But to do that creates risk because we don't know how it's going to turn out. What we need to do then is to realize that risk brings us the joy in life. If there were no risk, there would be no joy. Look at what happens on the movie screens, where there's always risk there. There's usually risk and love and sex all tied together because they are tied together. And there's a great deal of similarity, which we'll talk about in the psychological part, between the way that you handle your money and also the way you handle your sex. But that's weeks down the road. Then in this week, what we did is we looked at the alligator. We want to get a good idea this week of how the alligator is constructed, the fact that you're seeing on the screen the balance line on 3 different time frames. Those balance lines, remember, are where the price would be if there were no new incoming information. So when the alligator is sleeping, it simply means that there's no new incoming information coming into the market. The only thing that will move the market is new incoming information. If there were no new incoming information, the market would never move. So there has to be new incoming information before the market will move. What we want to do is we want to see that new incoming information before it changes the price. So next week, we're going to be looking at the momentum, which changes before price does. We call next week tomorrow's Wall Street Journal. We call the week after that today after tomorrow's Wall Street Journal. And Justine and Tracy are going to take you through the AO and the AC. Now, this is your 3rd weekend. This is your 3rd date with your inner trader. And hopefully the past 2 weekends you've done something different, you've done something new, and I hope you're beginning to see how all of this ties in, that the new incoming information, by allowing chaos into our life, by doing something we don't plan, something we do by ourselves, and something maybe even a little foolish, like giving away a $10 bill or a $20 bill, adds to this way of living. And this way of living permeates not only your trading, because you trade what you believe. We would trade our belief systems, and we're changing our belief systems. So this weekend date with your IT and the 3 pages that you write every morning are the keys that unlock this new personality that's inside of you that's trying to get out. So have yourself a great weekend. We'll try to do the same. We'll be back with you next week where we'll look at the fractal. We'll see you then. Enjoy your life.